Imagine, for just a second, that you've worked literally your entire life to build up a massive fortune, and you decide to invest it into a business. But, well, here's the catch. You don't actually get to run it. You're handing over the keys to the vault to a group of complete strangers. You just kind of have to sit back, cross your fingers, and hope they manage your money perfectly. Sounds a little terrifying, right? Well, you've actually just conceptualized the reality of modern corporate investing. When you pour your money into a business run by a totally separate management team, how do you know they're telling you the truth about your money? Really, how do you know the vault is secure?
Welcome to This Explainer. Today we're going to decode the fundamental mechanics of corporate trust. We are going to break down the structured auditing process to understand exactly how the global financial ecosystem actually keeps businesses accountable, honest, and functioning day in and day out. Here is our quick roadmap for today's explainer. We're going to break this complex ecosystem down logically into 5 parts. First, the evolution of trust. Second, defining the audit process. Third, the responsibilities of key players. Fourth, bridging the expectation gap. And finally, the traits of effective auditors. Let's kick things off with Section 1, the evolution of trust. To really grasp why we need auditors today, we actually have to rewind a bit. It's so fascinating how assurance services trace all the way back to the 18th century Industrial Revolution. Before this, businessmen generally just ran the small shops they owned. But as industries completely boomed, they needed to pool their resources together to expand. So they formed what we call joint stock companies. Suddenly, the people who owned the company, the shareholders, were no longer the same people running the daily operations, the directors or the management. This was a massive historical shift, the true separation of ownership and management. And, as you might guess, with that separation came an absolutely urgent need for monitoring. This shift birthed a core dynamic that we call the agency relationship. The shareholders act as the principals, they provide the capital. The directors act as their agents. They're the ones actually managing the resources and the company assets on behalf of those owners. So it's really a relationship of stewardship. But because the owners simply can't just take management's word that everything is running perfectly, a strict system of accountability is required. Management has to prepare annual financial statements to present to the shareholders, but the shareholders can't fully trust information prepared by the exact same people they're trying to monitor. Which brings us right into Section 2, defining the audit process. So what is this process exactly? Well, an audit is defined as an independent examination of an entity's financial statements. It's essentially the ultimate bridge of trust. Because shareholders can't just trust management grading their own homework, an independent expert, the auditor, is brought in. Their objective is to examine those financials and provide a professional, unbiased opinion on whether they are true and fair. Meaning, are they free from significant errors or deliberate fraud? But wait, is every single business forced to do this? Not exactly. On one hand, we have statutory assurance engagements, and these are required by law. Like, for example, under the Companies Act 2017. If you're a major public company, you have absolutely no choice. The law mandates an audit to protect the public. But on the flip side, we have non-statutory assurance engagements. These are totally voluntary. Think local clubs, sole proprietorships, or small partnerships. They might request an audit just to tighten up their internal controls or to make their financial statements look way more credible if they're, say, trying to get a bank loan. Moving right along to Section 3, responsibilities of key players. Let's map out this ecosystem really quickly. There are basically 3 main entities involved here. First, management, who handles the financial reporting. Second, the auditor, who's responsible for the audit itself and giving that opinion. And third, the users, or shareholders, who actually take those final financial statements and use them to make their big business decisions. Let's break down the first 2 a bit more, starting with management. A lot of folks actually think the auditor just rolls in and builds the financial statements from scratch. No way. Management does the heavy lifting here. It is explicitly management's responsibility to prepare and present the financial statements using an applicable financial reporting framework, or AFRF for short. Plus, they have to design and implement the internal controls needed to make sure those statements are actually reliable. And lastly, when the auditor finally arrives, management has to give them unrestricted access to all relevant information and the people inside the entity. The whole audit is based on the premise that management accepts these specific responsibilities. Now, contrast that with the auditor's task. The auditor is strictly there to obtain reasonable assurance that the financial statements, as a whole, are free from material misstatements, whether those are caused by an innocent error or intentional fraud. Once they do their digging, their job is simply to express an independent opinion in a formal report and communicate whatever they find to the relevant parties. Now, notice I just said material misstatements. That is an absolutely crucial concept in auditing. Let's ground this with a real-world perspective from our sources. Auditors do not check every single solitary transaction looking for missing pennies. They focus on material items, things big enough to actually change a shareholder's decision. For example, if a company is pulling in 1 million rupees profit and the auditor spots a 100 rupee error in the petty cash drawer, that is immaterial. It doesn't change the big picture at all. But if there are 200,000 rupees of unrecoverable receivables, debts the company is definitely never going to collect, that is highly material. The auditor is absolutely going to focus on that.
All right, move into Section 4, bridging the expectation gap. So, let me ask you this. When an auditor signs off on a company's books, are they guaranteeing that the financial statements are 100% perfect? Do they literally sit in a windowless back room somewhere checking every single receipt, invoice, and transaction? Think about what the general public usually assumes an auditor does. That disconnect between what the public expects an auditor to do and what their actual responsibilities are, we call that the expectation gap. And it's on the users to close this gap by understanding how it really works. So let's bust a few common myths right now. Myth 1, the auditor prepares the financial statements. False. As we just covered, management handles that. Myth 2, the auditor checks 100% of the transactions. False again. They rely on sampling and strictly focus on materiality. Myth 3, the auditor provides absolute assurance. False. They provide reasonable assurance. Absolute perfection is literally impossible because of the inherent limitations of any audit. And myth 4, the auditor's job is to prevent and detect all fraud. False once more. Management is primarily responsible for preventing fraud by setting up those internal controls we talked about.
Now on to our final section, Section 5, Traits of Effective Auditors. Knowing what an auditor actually does, what kind of professional toolkit and mindset do you need to execute this incredibly rigorous job? Well, the very first, completely non-negotiable pillar is independence. An external auditor must have absolutely zero ties to the client. This breaks down into 3 distinct areas. Financial interest. The auditor cannot own shares or have investments in the client's company. Personal relationship. No close family or personal ties to the company's management. And employment connection. You definitely can't have a side hustle or any direct link with the client. Without absolute independence, the auditor's opinion is completely worthless because the public simply won't trust it.
The second pillar is professional judgment. Auditing is definitely not just blindly ticking boxes on a checklist. It requires making incredibly complex decisions using specialized knowledge, training, and experience, and this applies across the whole shebang. During the planning stage, the auditor uses their judgment to assess risks and figure out what's material. During the performance stage, they judge the nature, timing, and extent of their procedures so they can gather enough evidence. And during the reporting stage, they use judgment to evaluate management's estimates and come up with their final audit conclusion.
And finally, the third, and honestly maybe the most fascinating pillar, professional skepticism. This basically means maintaining a relentlessly questioning mind and critically evaluating all the evidence. The big takeaway here is that an auditor has to apply skepticism even if management has been perfectly honest in the past. You never ever just assume integrity. You have to stay totally alert to conditions that might indicate a misstatement at all times. It is the ultimate trust but verify mindset. So why is this skepticism such a big deal? Because it's the exact rater that detects unusual transactions and catches material misstatements. It prompts the auditor to dig deeper when they're handed conflicting evidence or when a document looks a little suspicious. It's basically a highly tuned antenna for fraud indicators. Without a highly skeptical mindset, an auditor could super easily jump to conclusions based on really limited evidence or make dangerously wrong assumptions. As we wrap up this explainer, I really want to leave you with a provocative thought. We started all of this by imagining handing over your hard-earned vault to complete strangers. We've seen exactly how the audit process, built entirely on independence and expert judgment, is what actually secures that vault. But at the end of the day, it all rests on the mindset of the people doing the checking. Just think about it. How stable would our entire global business framework be without that invisible pillar of professional skepticism? If we just took everyone at their word, how quickly would the mechanics of trust completely fall apart? It's a wildly fascinating ecosystem, and I really hope this explainer has helped make its complex gears just a little more transparent for you. Keep questioning, keep learning, and thanks so much for joining. Okay, let's dive right in and bust a massive myth right up front. A lot of people think an auditor's job is to walk into a company, check the books, and provide an absolute guarantee of total perfection.
Well, if you think an auditor blesses every single transaction as completely flawless, think again. Instead, an auditor is really more like a highly structured investigator navigating the complex ecosystem of a business. Welcome to this explainer. Today, we're going to unpack the really fascinating relationship between two absolutely critical auditing standards, ISA 240, which deals with fraud, and ISA 315, which focuses on risk assessment. We're going to see exactly how these two standards interlock to guide the auditor's abstract investigation.
To do that, we'll progress through 6 foundational steps: responsibility for audit fraud, the professional skepticism mindset, risk assessment under ISA 315, 2 levels of fraud risk, identifying indications of fraud, and finally, the auditor's final response. All right, kicking things off with step 1, responsibility for audit fraud. Let's start by drawing the boundary lines here and asking a very fundamental question. If a massive fraud occurs within a company, whose responsibility is it primarily? Who gets the blame? Well, the standard actually draws a really stark contrast. Fraud is primarily the responsibility of management and those charged with governance. It's management who must architect the internal controls and actively create a culture of honesty and ethical behavior. The auditor, on the other hand, their responsibility is to maintain a skeptical mindset and identify the risks of material misstatement. But, and this is key, they cannot guarantee a completely fraud-free environment. And you might be wondering, why is that? Why can't an auditor provide absolute assurance? It's because of the inherent limitations of detecting fraud. Unlike a simple bookkeeping error, fraud is intentionally hidden. It's properly planned and organized. Think about collusion for a second. You might have a supposedly perfect dual control system where 2 employees have to sign off on cash. But what if those 2 employees become best friends and decide to steal together? The control is completely bypassed. And honestly, perhaps the most dangerous limitation is that senior management, the very people who built the controls in the first place, have the power and access to simply override them. Which brings us right to step 2, the professional skepticism mindset. So, if management can collude and override systems, how on earth does an auditor fight back? It's with the magnifying glass of professional skepticism. This is an attitude that includes a questioning mind, being constantly alert to conditions that might indicate a misstatement, and critically assessing every single piece of audit evidence. It's a concept rooted deeply in ISA 200, but let me tell you, it is completely vital to identifying fraud under ISA 240. You literally cannot navigate one without the other. And look at this quote, it's absolutely crucial. The standard mandates that you maintain the skepticism irrespective of past experience and the culture of honesty and integrity of management. Meaning, even if you've audited a company for 10 or 15 years and you genuinely believe the management is incredibly honest and has unparalleled integrity, you must never ever turn a blind eye. You just can't let your past comfort dictate your current investigation. To keep this skepticism sharp, the standard actually requires the engagement team to sit down together and discuss exactly this question. The whole team, from the person auditing cash down to the person auditing revenue, needs to brainstorm. They have to ask, if this company were to commit fraud, what are their pain points? Where are their vulnerable spots? Because fraud rarely happens in isolation, right? It almost always leaves a trail across different departments. Okay, moving on to step 3, risk assessment under ISA 315. Once we have our skeptical mindset locked in, we deploy our methodology to figure out exactly how to map out the danger zones. We follow a very strict architecture here. First, we perform risk assessment procedures. We inquire with management, those charged with governance, and the internal audit function. We also run analytical procedures. Second, we look for the classic rule of 3 and fraud risk factors. Is there an incentive or pressure? Is there an opportunity? And is there an attitude or rationalization that justifies it? And finally, based on what we find there, we formulate our specific audit response. Let's put this in the real world. Why would a company artificially inflate its revenue? Well, look at the external pressures. Perhaps there's a brutally high degree of market competition, or rapid technological changes are making their core products obsolete. Maybe they have bank loans with incredibly strict covenants, and if they show even a slight loss, the bank will demand all its money back instantly. Or maybe they're trying to get listed and need to show massive growth to attract investors. These are the intense pressures that can push otherwise honest people to do dishonest things. And that leads us right into step 4, 2 levels of fraud risk. As we assess all these pressures, ISA 315 tells us that audit risks actually divide into 2 distinct levels. We have the broad financial statement level and the zoomed-in assertion level. Financial statement level risks are pervasive. They infect the entire document and affect many different assertions at once.
Assertion-level risks, however, are hyper-specific. They target certain line items, like the completeness of expenses or the accuracy of revenue recognition.
At that broad financial statement level, the ultimate, ever-present villain is management override of controls. No matter how good your past experience has been with a client, this risk is always assumed to be present. Executives might inject fictitious journal entries right at year end to hit a target. They might deliberately alter underlying accounting records. Or they might subtly change the assumptions used in really complex accounting estimates, like tweaking the useful life of an asset from 5 years to 10 years, just to manipulate the depreciation expense. Now zoom into the assertion level and consider this highly specific scenario. Imagine the board of directors tells management, hey, if you keep expenses below $100 million this year, you all get a $5 million bonus. What is the massive risk here? The immediate risk is that management will simply stop recording expenses. Therefore, the completeness assertion of expenses is directly threatened. They literally have a $5 million incentive to hide the true cost of doing business. Now for step 5, identifying indications of fraud. So you're deep in the performance phase, right? You're digging through the numbers and suddenly you spot a $300 million revenue entry recorded just 2 days before year end. And there is absolutely zero supporting documentation. No sales order, no purchase agreement, nothing. You have to stop and ask yourself this Socratic question. Is this just an honest bookkeeping error, or are you looking at a glaring indication of fraud? A simple error is a typo, but when you look at the surrounding circumstances, certain things are screaming red flags. Missing documents for massive transactions, documents that physically appear to have been altered, like turning a $100 invoice into a $15,000 invoice, or unexplained reconciling items. Imagine your ledger says you have $100, the bank statement says you have $1, and when you ask management about that $99 difference, they get super evasive and just shrug, saying, I don't know. Those aren't errors. Those are strong indications of potential fraud. Finally, we reach step 6, the auditor's final response. So what happens when our abstract investigation actually uncovers these glaring red flags? If management is dodging questions and the math absolutely doesn't add up, what does the standard require us to do? We don't just ask them to fix it, we have to escalate the situation systematically. First, we have to revise our entire initial risk assessment. Second, we aggressively expand our audit procedures, bringing in more experienced team members and incorporating an element of total unpredictability into our testing. Third, we must now formally doubt the integrity of management, which means reevaluating every single piece of written representation and evidence they previously gave us. And ultimately, if the situation is severe enough, the auditor might need to seek legal counsel or just withdraw from the engagement entirely. Which brings us to a pretty intense final thought. An audit is an entire ecosystem built on interlocking standards, but it relies on a bedrock baseline of evidence. If management's integrity falls, every single piece of paper they've ever handed you becomes suspect. Does the entire foundation of the audit collapse with it? And if that foundational trust is broken, how far must an auditor go to find the truth? Think about that the next time you look at a set of financial statements. Thank you so much for joining me on this explainer. And as always, keep questioning them.